Let me be clear. This is not a top 3 ETFs video. If you came here looking for a shopping list, you're probably going to be disappointed. Because ETFs are tools, and tools are useless if you don't understand the job they're meant to do. So instead of telling you what to buy, I'm going to show you how I think about ETFs. Once you understand that, you won't need YouTubers to tell you what to invest in. That's how real investors are built. Most investors don't lose money because they choose the wrong ETF. They lose money because they expect ETFs to do things they were never designed to do. They want safety and excitement, growth and stability, fast results with zero discomfort. Markets don't work like that. ETFs don't exist to make you feel smart. They exist to make you disciplined, and discipline is the most underappreciated edge in investing. Here's the core idea of this video. I'm not giving you recommendations. I'm giving you a framework. Every long-term portfolio needs 3 roles to be filled, not 3 tickers. 3 roles. Once you understand these roles, you can swap ETFs in and out without breaking the system. That's the difference between copying portfolios and actually understanding investing. Role number 1, the global core. Most portfolios you see online are making a silent assumption that the US will always outperform. Maybe it will. Maybe it won't. The market doesn't owe us certainty. That's why, for a global core, I like thinking in terms of total world exposure. An ETF like VT, which holds companies from the US, Europe, Asia, and emerging markets, represents this idea well. This is not about maximizing returns. It's about resilience. If capitalism grows anywhere on the planet, a global core benefits. It won't always beat the S&P 500, and that's okay, because its job isn't to win every year. Its job is to survive every decade. Role number 2, behavior control through quality. Volatility isn't just a number on a chart. It's psychological pressure. Most people don't sell because the math tells them to. They sell because they can't sleep. That's where quality-tilted or low-volatility ETFs come in. An ETF like USMV is designed to reduce extreme swings by focusing on stocks that historically move less. Let's be clear. This does not guarantee higher returns. And that's not the point. The point is behavioral survival. If an ETF helps you stay invested during bad markets, it has already done its job. The best strategy on paper is useless if you abandon it in real life. Role number 3, asymmetric growth. Growth is optional, but asymmetry is powerful. This role is about exposure to innovation, technology, and long-term upside. An ETF like QQQM, which tracks the same companies as QQQ, but with a lower expense ratio, fits this role cleanly. This is not your foundation. This is your upside. It will be volatile. It will drop hard during market stress. And that's exactly why it's a slice, not the whole pie. You don't use growth ETFs to feel safe. You use them to capture the future. Now, an important clarification before we move on. The ETFs mentioned in this video are examples, not recommendations. They're here to explain roles inside a portfolio, not to tell you what you personally should buy. This is not financial advice. Your age, income, risk tolerance, and goals matter. So always do your own research and choose ETFs that fit your investor profile. Different investors need different tools. Understanding the framework matters far more than copying the exact ETFs. At this point, some people say, "But ETFs are expensive. I can't afford them." No, ETFs aren't expensive. Inconsistent thinking is expensive. Most modern brokerages allow fractional shares. You don't need perfect timing. You don't need a large lump sum. You need rhythm. This is where dollar cost averaging belongs. Not as a magic strategy, but as a permission slip to start. Regular, automated investing removes the need to be right. And removing the need to be right is incredibly powerful. Here's the quiet truth about wealth. It's not built by prediction. It's built by defaults. Good defaults. Boring defaults. Repeatable defaults. ETFs don't promise excitement. They promise structure. They don't care about headlines. They don't react to emotions. They just keep compounding while most people overthink. You don't need more information. You need a system you can live with for decades. ETFs won't make you rich overnight, but they can make you rich quietly. And quietly is usually how real wealth is built. If you want calm investing, clear thinking, and systems that survive bad years, hit the like button and subscribe for more simple Stickman finance breakdowns. This is Stickman Invests. Simple frameworks, real discipline, long-term wealth. Thanks for watching, and I'll see you in the next video.